With its market cap hovering at $835 billion and its stock trading at 10 times what it was worth a year ago, it's easy to buy into the idea that Tesla is the world's most valuable automaker. However, founder and boss Elon Musk isn't blinded by his company's overblown paper value and wants his executives to know that they shouldn't be either. Here is Tsla Stock Let's Talk, warning to investors. If you're a subscriber, well, welcome back to Investing Few. But if you're new to this channel and you want to enjoy more of our engaging content, make sure to click that subscribe button and use that trigger finger by smashing the like button. Now, let's get into it. Elon Musk has made so much money from Tesla that he is now the richest person on the planet. However, the second biggest winners are investors and an Edinburgh-based investment manager that began backing Musk's electric car company in 2013. Tech companies have seen their values soar this year following a surge in profits as the pandemic has driven the adoption of digital services and moves to decarbonize economies has accelerated the purchase of electric cars. Apple, Facebook, and Microsoft are also expected to report bumper sales and profits when they report their latest quarterly results on Tuesday and Wednesday. Analysts will be keen to see what targets Musk sets for Tesla in 2021. In October, one analyst predicted sales this year of 840,000 to 1 million vehicles. At the time, Musk said his own target was in that vicinity, and the analyst was not far off. The company came within a whisker of hitting its $500,000 car sales target for 2020, selling 499,550 vehicles despite the pandemic shutting down some production. As Tesla's share price continued to soar in value, it triggered a warning alarm that the Tesla stake had crossed the maximum percentage value that Scottish Mortgage was able to hold in any single stock. That meant fund managers James Anderson and Tom Slater had to sell Tesla's shares to keep within their rules. In a sign of just how high expectations were, shares of data warehousing company Snowflake (SNOW), which was the biggest tech initial public offering of 2020, slid after reporting its first quarterly results as a public company. This decline, shares went down about 4% in after-hours trading, came despite 119% year-over-year growth in revenue. The company still isn't profitable, but for high-growth, cloud-based software companies like Snowflake, Wall Street usually only sees that as a temporary setback. Musk warns employees on Tesla stock. Tesla CEO Elon Musk, in a letter to employees, warned that the high-flying electric vehicle stock could get crushed like a souffle under a sledgehammer if costs aren't controlled at the soon-to-be S&P 500 member. Musk occasionally issues dire warnings like this and occasionally even opines on Tesla stock being overvalued. Anybody who'd kept Musk's past warnings in mind would have missed out on some pretty incredible gains in 2020, a year in which the stock is up nearly 580%. Musk noted that Tesla's actual profitability is very low, registering at only 1% in 2019. Quote, "Investors are giving us a lot of credit for future profitability," he wrote. "But if at any point they conclude that's not going to happen, our stock will immediately get crushed like a souffle under a sledgehammer." It's not the first time Musk has sounded the alarm on Tesla's share price. In May, just after Tesla stock hit a 3-month peak on strong Q2 financial results, the CEO tweeted, seemingly out of the blue, that he thought Tesla's stock price was too high. The only way to prevent an ugly stock collapse is selling more cars while keeping costs as low as possible. Quote, "This is a tough game of pennies," Musk wrote in an email, requiring thousands of good ideas to improve part cost, a factory process, or simplify the design while creating quality and capabilities. A great idea would be one that saves $5, but the vast majority are 50 cents here or 20 cents there. Tesla already implemented a series of cost reduction measures in early 2020 when the coronavirus pandemic started weighing down global auto sales, firing an undisclosed number of workers after an annual performance review process and temporarily cutting some employees' pay. However, all that might not matter much if the company keeps burning billions of dollars elsewhere. On Tesla's third-quarter earnings call, the company's CFO, Zachary Kirkhorn, said Tesla plans to ramp up its capital expenditures by $2 billion, from previously planned $2.5 billion in 2021 and 2022 to fund new projects, such as battery cell manufacturing and a new gigafactory in Germany. On the other hand, with 4 weeks left in 2020, Tesla did everything it could think of to boost year-end delivery. A number of Cybertruck reservation holders told Electric that they'd receive emails from Tesla encouraging them to lease existing Tesla vehicles while they wait for the yet-to-enter production electric pickup truck. Tesla has promised investors to deliver 500,000 vehicles in 2020. The company needs to deliver over 181,000 vehicles in the fourth quarter in order to achieve that goal. In the last quarter, the automaker delivered 141,000 vehicles, and that is just amazing. Tesla Inc.'s most bullish Wall Street analyst predicts the electric car maker's dizzying rally will accelerate this year, and that the stock will trade in the $640 to $960 range in 2021. New Street Research analyst Pierre Ferragu anticipates the company will sell 2 million to 3 million cars per year after 2025 at industry-leading margins, justifying a market capitalization of $230 billion to $350 billion, or about $1,100 to $1,700 per share. Tesla is set to report quarterly earnings next week. Shares of the company rose as much as 6.9% to touch $545.90 in New York, and have increased more than 100% over the past 3 months. A surprise third-quarter profit and strong deliveries for the fourth quarter helped fuel the rally, along with the opening of its China plant. Ferragu, who raised his price target to $800 from a previous $530, expects the company to beat estimates for free cash flow when it releases fourth-quarter earnings on January 29th. He also predicts 2020 delivery guidance will exceed projections and sees a potential drop in gross margins in the first half of the year as Shanghai-assembled Model 3s, which have a higher fixed cost per car, increase in the overall mix. Tesla shares outperformed all other major stocks by a wide margin last year, rising 743%. So does that mean its incredible run is behind it? Maybe not. The first week of 2021 once again saw Tesla among the S&P 500's best performers, rising 24.7%, just 1 percentage point behind market leader L Brands, or LB. This week's gain on top of Tesla's performance last year was enough to make CEO Elon Musk the richest person on the planet, and its shares surpassed Facebook to become the 5th most valuable U.S. stock. If it keeps up the first week's pace of increase, Tesla stock would match all of last year's gain by mid-March. Not that anyone is predicting another 700% increase in shares this year, or even a tenth of that. In fact, even some of the most bullish analysts are only forecasting that Tesla shares would hit $1,000 by the end of the year, about a 14% rise for the rest of 2021 from Friday's record high close. Several analysts with relatively positive outlooks for the company have 12-month price targets well below Friday's $880 close. The current mean target price for analysts is $440, which would be a 50% drop in shares. Of the 35 analysts following the stock, 13 have a strong buy or buy recommendation, and another 11 have a neutral or hold recommendation. Of the rest, 7 have a sell recommendation and only 4 a strong sell. Tesla has been tremendously successful in recent years. Now, the stock is not cheap by any valuation metrics. For this reason, you can't say it's a value buy or it has the potential to replicate its gains from the past year to 2021. Tesla stock is up an incredible 695% in 2020, making it one of the most valuable companies in the world with a $630 billion valuation. Easily the top reason to buy into the Tesla thesis is the company's competitive edge over other auto stocks. Additionally, Tesla's share price going vertical in 2020 has all but eliminated cash concerns for the company. Tesla is still the best-positioned company in EVs and AVs under our coverage due to its people, its technology, business model, and access to capital. What do you think of the warning about Tesla stock? Let us know in the comments section below. And hey, if you enjoyed this video, don't forget to like and subscribe to our channel so we can continue giving you the best content. Thanks for watching, and we'll see you in the next video.